There are several numbers of shares. There are several numbers that relate to the numbers of shares of a company. There is the authorized share count, which is the maximum number of shares a firm can issue. Then there's the issued shares, which is the number of shares a firm has ever issued. Yeah. And then there is the outstanding shares, the number of outstanding shares, and this is the most relevant. And this is the number of shares that the share owners of the company own. Yeah, this is by far the most relevant. And this is the issued shares, outstanding shares. Yes, let me write that. Outstanding shares. Is issued equals issued shares minus treasury shares. Treasury shares. And treasury shares are the shares that the company has bought back. Yeah, that the company has bought back. And when you want to calculate earnings per share, earnings per share, this is earnings per share. And that's it. This is the total earnings of a company, which is the net income, earnings, which is the net income, divided by brackets income divided by the number of outstanding shares. Outstanding shares. Yeah. So when you want to know what your earnings per share is, you divide the net income of a company, which is the earnings, net income of a company divided by the number of outstanding shares. So this is the most relevant. Yeah, and this is why companies buy back their own shares. They buy back their own shares because by buying back their own shares, the number of outstanding shares goes down. And when the number of outstanding shares goes down, the fraction of the company that one share owner owns grows. It gets bigger. Yeah, that's the reason why companies do buybacks. At least intelligent companies. Yeah, intelligent companies know that the denominator in this equation goes is getting smaller when when they engage in buying back their own shares. And the effect is even larger when the share price is low, because when the share price is low, a company can buy back more shares for the same amount of money. Yeah, that's why share buybacks make the most sense when the share price is undervalued. Yeah. Okay. Are there any questions? Are there any questions? So far, so good. Okay. So what are the treasury shares? Treasury shares are the shares a firm has issued and rebought, yeah, and bought back. So this is, here we are talking about buybacks. And there are several reasons for buybacks, but the most important one is that buying back shares increases the cake of the share owners. Yeah, they have a bigger piece of the pie after the buyback. Yeah, and they have a higher earnings per share, even if earnings or net income is the same after the buyback, because the denominator in the equation I just showed you is getting smaller. Yeah, the number of shares outstanding is getting smaller, and so the earnings per share is increasing. Which is good for a single shareholders because he has a bigger piece of the case. That's why of the cake. That's why companies engage in buying back their own shares. Treasury shares is a contra account to share owners' equity. Yeah, that means it is you have to reduce it. You have it has a minus sign. Yeah, it's an equity account, but it has a minus sign, and it's recorded as at cost. Cost means the stock price when purchased. So it's a contra account. It carries a debit balance. Yeah. And on the balance sheet, where debit balance normally on the asset side, yeah, but this is on the liability side, on the equity side, and that is correct because it's a contra account. Yeah, it has a negative amount, and so treasury shares, buying back shares, is kind of like the opposite. Has kind of like the opposite effect of issuing shares. Yeah, issuing shares increases assets and equity, and repurchasing shares decreases assets and equity. Yeah, and here we have the journal entry for a buyback. The company buys back 100 shares, and the market price is 200 euro. Yeah, what do? You debit treasury shares, 20,000, and you credit cash. What are the elements of the accounting equation that are affected here? Tell me. What are the elements of the accounting equation? It's your turn. Yeah, exactly. Equity goes down because treasury shares goes up, and treasury shares is a contra account to equity with a minus sign, and assets goes down, correct? Because cash goes down. Yeah, when you credit cash, it goes down. Yeah, does that make sense to the others, or are there any questions related to this? No questions? Retained earnings is a part of shareholders' equity, yeah. And retained earnings actually, if a company retains its earnings, it is a major source of financing. Maybe actually one of the biggest sources of financing. And when a company retains its earnings, this increases the firm's equity. And what is retained earnings? It is accumulated earnings less net losses, less dividends. Accumulated earnings less net losses, less dividends. Yeah. So if you have retained earnings, that increases equity. If you have a dividend, you take something out, and this does not increase equity. Retained earnings is not cash. Yeah, it might be that you have a lot of retained earnings, but it is invested in property, plant, and equipment, or any other asset, but it's not cash. Yeah, you have to be aware of that. So again, we have a couple of exercises. Let's start with the first one. The shareholders' equity section of a corporation balance sheet reports discounts on bonds payable or treasury shares. Is it A, no discounts on bonds payable and treasury shares? Discounts on bonds payable and no treasury shares? C, no discounts on bond payable and no treasury shares? Or yes for both? What do you think? It's your turn. Which of the answers is correct? Is it A, B, C, or D? Exactly, yeah. Discount on bonds payable has nothing to do with equity, but treasury shares are reported under shareholders' equity. So A is correct. Very good. Very good. Very good. Next one. The purchase of treasury shares decreases total assets and increases total shareholders' equity. Decreases total assets and decreases total shareholders' equity. Has no effect on total assets, total liability, or total shareholders' equity, or increases one asset and decreases another asset. Think about it and then tell me what is your answer. Exactly. So you say B, Liang? B? Okay, B is correct. B is correct. Yeah. If you look at the accounting equation, if you're buying back shares, which accounts are affected, Liang? Yeah, cash is assets. Very good. Yeah, the contra account to equity with a minus sign, therefore equity goes down. Good. This is the next one. The denominator for computing earnings per share is number of shares outstanding at year end, number of ordinary shares outstanding at year end, weighted average of preferred shares outstanding, or weighted average number of ordinary shares outstanding during the year. Actually, it is the weighted average number of ordinary shares outstanding during the year, when the company only has ordinary shares. But it is the weighted average. But I think we didn't about this, so you can have that so far. So no, there is the weighted average. If the company has only ordinary shares, then it's the weighted average of ordinary outstanding during. Okay. Are there any questions? Then I send you the new slides. Give me 1 minute. Did you receive the new slides?
Yes.
Yeah. You're welcome. So this is a new section about the statement of cash flows. And the statement of cash flows is about cash flows, which is obvious, but it really tells us about where the cash is coming from and where the cash is going to. So it's about the sources of use and uses of cash. Yeah, because cash, the pure amount of cash that a company has, can be seen on the balance sheet. Yeah, you know that cash is an asset, and you can see cash on the balance sheet at the end of the year and at the beginning of the year. You can also see whether it has increased over the year if you take the difference. But the statement of cash flows shows the sources of and uses of cash. Where did cash come from, and where did cash go to? Yeah. So the statement of cash flow reports the cash inflows and the cash outflows. What might be a cash inflow, for example? You have an idea?
The company earns from the customer.
Yeah, the customer, the company gets cash from the customer when it's selling something. And what might be a cash outflow?
Buy something.
Buy something and pay cash. Exactly.
Buy the assets.
Yeah, buy the assets. So the statement of cash flow is divided into the cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Operating activities is what you said when you sell our products and the customer is paying. Yeah, usually the cash flow from operating activities is higher than net income. Yeah, it's higher than net income, and it's almost always positive. Yeah, cash flow from investing activity is when you buy an asset, when you invest into property, plant, and equipment, for example. Do you have an idea what might be cash flow from financing activities?
The interest rates.
Okay, yeah, when we're talking about interest, or when we pay back our debt, for example. Yeah, when we pay back our debt, or when we borrow more money. Yeah, this is financing. The cash flow from operating activities can be calculated using the indirect method or the direct method. Yeah. Actually, IFRS says we prefer the direct method, but the truth is that 99% of the companies, they use the indirect method. And that's why it's much more relevant in practice. Almost all companies use the indirect method, and that's also why we talk about the indirect method. We look at the indirect method, and it's indirect method because it starts with net income. It starts with the bottom line of the income statement, and then adds back certain amounts of certain expenses that are not paid out as a cash, and therefore it's called the indirect method. So the cash flow from operating activities actually represents the core business. Yeah, represents the core business. And it shows the revenue generating activities. So for example, if BMW is selling cars, yeah, you sell your products to the customers, you provide your service, and they pay us. Yeah. So, and actually the cash flow from operating activities is the most important part of the cash flow statement. If this is not good, then the whole business is in a mess. And here you see how it goes. Yeah, this is the cash flow from operating activities. It's the indirect method. Why is it the indirect method? Because you start with net income. You start with the bottom line of the income statement, and then you add back certain expenses. For example, depreciation and amortization. Why depreciation and amortization? Because depreciation and amortization was deducted. Yeah, if you want to come to net income, you have to deduct depreciation and amortization. Depreciation and amortization. This is depreciation and amortization, and you have to deduct that, yeah, to come, and you have to deduct several other expenses to come to net income. Yeah, but the thing is that depreciation and amortization each is an expense, of course. It's not a cash outflow, and that's why you add it back. You add it back here, yeah, to come to the cash flow from operating activities. Yeah. Accounts receivable. If accounts receivable have increased, you have to deduct that. Why is that the case? Because customers really have to pay us. If not, then also it's net income. It's not a cash flow because you have not yet received the money. Yeah, you have not yet received the money, and that's why you have to deduct that from the net income. The same goes for inventory. Yeah. When you buy inventory, cash goes down. Yeah, similar than buying property, plant, and equipment. Yeah. So generally speaking, to convert net income into cash flow from operating activities, you add back depreciation and amortization, because this is a non-cash expense. It decreases net income, but it does not lead to a cash outflow. And the rest is, if you have an increase in asset, you have a decrease in cash, and vice versa. Yeah, because here we have not collected this money. Yeah, we have not collected this money yet, and that's why we have to decrease it. We have to deduct it. Yeah, if accounts payable go up, this is the other way around. If accounts payable go up, then we have to add them. If they decrease, as it is the case here, they have to go down. Does that make sense?
Yes.
Yes, Richard? Okay. If there are no questions, then we go on. The next section is the cash flow from investing activities. Yeah, and the cash flow from investing activities, it's do you think it's positive or is it negative? Do you think investing needs money, or do you think investing gives you money? If you buy, if you buy something, does it take your money if you invest, or does it? Yes, exactly. Yeah, and that's why the cash flow from investing activities is mostly negative, because if you invest, and companies have to invest in order to grow, even if you want or to remain the capital stock and not grow, you have to invest. Yeah, because the assets actually, they depreciate and they lose value over time. So you have to invest to stay in business. And if you invest, you need money, and that is a cash outflow. Yeah. And the cash flow from investing activities shows the purchase and the selling of long-term assets, but normally purchases are larger than the selling, and purchases of other businesses. Yeah, you can also call this M&A, mergers and acquisition. Yeah, M&A. Yeah, so it's not always a bad thing. If this cash flow from investing activities is negative, it's normal. It's normal because companies have to invest to stay competitive And if they want to grow, they have to invest even more. Here you see how the cash flow from investing activities looks like. You have capital expenditures. Yeah. Do you remember what capital expenditure means? What does capital expenditure mean? It's when you buy assets, when you buy long-term assets. Yeah, assets increase. Yeah, you buy property, plant, and equipment. Property, plant, and equipment, which is assets. Yeah. So in this case, it has cost us 15,000 or whatever it is. We have an acquisition of an entity. Yeah, this is M&A. Yeah, M&A. And we have also sold some property, plant, and equipment, but this is lower than our net investments. Yeah, sold some property, plant, and equipment. But the net effect is negative, which is normal, yeah, because we invest more than we disinvest. Does that make sense? Can I go on?
Yes.
Yes, okay. And then we have the cash flow from financing activities. The cash flow from financing activities relates to share owners' equity and long-term liabilities. And it shows how the firm receives and pays cash to and from investors and creditors. Yeah, and in this case, investors means share owners. Yeah, share owners. Yeah, and creditors, this is debt holders. Yeah, it's debt holders. Here you see the cash flow from financing activities. And in this case, the company has repaid long-term debt. Yeah, repaid long-term debt, which is a negative sign, because if you repay long-term debt to the debt holders, then it's a cash outflow. Yeah, but the borrowing is larger than the repayment. Yeah, therefore we have actually more money is coming in from borrowing than we pay back. We have cash dividends. Cash dividends, if the company pays dividend, that's an outflow. Yeah, does it make sense? Dividend and outflow. Because when the company is paying a dividend, then the money leaves the company. Yeah, it leaves the and it goes to the shares. And the same is with repurchases of stock. It's also an outflow. Yeah, and therefore, in this case, the cash flow from financing activities, the net effect, it is negative. Yeah. Does that make sense?
Here, yes.
Okay. What about, think about, in this case, there was no issuance of stock, but think about a company issues new stock, makes an IPO. Is this an outflow or is it an inflow? Is it a Liang? Yeah, it's a plus. It's a plus. It's the opposite than a repurchase. Yeah, if you have an issuance, then it's a plus. Very good, Liang. Here you see how the cash flow statement affects the balance sheet, or how the cash flows affect the balance sheet. For example, here, investing cash flow affects long-term assets. Yeah, if you invest, you use money. Property, plant, and equipment, for example, goes up. Yeah, property, plant, and equipment goes up. Financing cash flows. Financing cash flow affects long-term liabilities. For example, if you issue new debt, or issue new shares, yeah, or repurchase shares, that influence this part of the balance sheet. And the operating cash flow is that affects current assets. Yeah, collections from customers, yeah, is cash. Yeah, or if you have payments to suppliers, yeah. So this operating cash flow collection from customers affects current assets, and payments to suppliers, current liabilities. So here you see the big picture. Here you see the big picture. The statement of cash flow in total. You see the operating activities as we've seen it. Yeah, here the operating activities is positive, which is normal. Yeah, you have the investing activities. The company is a net investor, so that means it's negative. And in our case, the cash flow from financing activities is also negative. Yeah, and if you add all this together, yeah, if you have 48 minus 22 minus 27, you come to the change in cash. Yeah, so 48 minus 22 minus 27 is minus minus 1. Yeah, and this is the change in cash. This is the change in cash. And here you see how with the statement of cash flows, actually, you see how the cash has changed. Yeah, this is the balance sheet. The balance sheet. You see the cash at the beginning of the year and at the end of the year, and you also see, of course, that it has decreased by minus 1,000, but with only the balance sheet, you do not see this one. You do not see the sources and uses of cash. You need the cash flow statement to see what the company has done, what it has, whether it has invested and that has used up cash, or whether it has issued debt that has brought the company cash, and so on. Yeah. Okay. Does that make sense? Clear. Okay. Then this is the last slide. Sometimes you might see some items classified differently. Sometimes interest expense is operating cash flow. Sometimes it's classified as financing cash flow. Yeah, but this is only a minor thing. And the same goes for dividend. Sometimes it's operating cash flow. Sometimes it's financing cash flow. So IFRS allows both, but this is not that important. Yeah. Okay. Thank you very much for your attention. Very good job today. Very good. You participated very well in the lecture, and also you used the microphone. And I wish you nice afternoon or evening wherever you are, and see you next week on Monday. Thank you.